illustrations?
The illustration is a hypothetical of today's snapshot.
Okay.
And, it's good for today. That illustration is good for today. But if you take that illustration out 10 years, 20 years, in some cases, depending upon the age of the insured, it could be up through a 50-year projection. It's just that. It's just a projection. The great thing that insurance companies are doing now is giving their agents the opportunity to get in-force ledgers on policies where you can compare the original illustration with a current illustration on how well the policy is performing. And if it's not done, if an in-force ledger is not done every year, it should be done every other year to see where am I relative to where I was when I started the policy.
Because there's usually certain assumptions that are built into those, and like if there's a
There
high
is.
interest rate that's built in there, and it's just unrealistic as far as
Well,
what's actually happening.
And since there's been so many policies that have had problems, regulations have come into play that insurance companies and insurance agents cannot illustrate an interest rate that is higher than what they're currently paying on any kind of fixed type product. On a variable product, which I am no longer licensed to provide to my clients, but on a variable product, they can put hypothetical numbers together, but they also have to show what happens at 0% return.
Okay. So it's sort of a range, what if things don't go right and what if things go really well?
So the illustration world has come, from a regulatory standpoint, has come up significantly to help the consumer. And there's also a glossary of terms of what the illustration means. But frequently people misunderstand that the illustration is not their contract.
Okay. Well, we've talked a little bit around this. Why don't we talk for a few minutes? What are some of the different types of life insurance policies, and when are they most appropriate?
Well, there's term insurance, there's universal life, there's whole life, and then there's the variable life. And term insurance is very appropriate for the younger family.
Can you tell us a little bit, what does term insurance mean?
Term insurance means that, number one, it's the least costly form of insurance. There's no cash value that builds up in it. It's strictly providing a death benefit.
Okay.
And what happens now in today's world, most term insurance is written in 5, 10, 15, 20, and 30-year increments, meaning that the insurance company is guaranteeing the premium on those policies for that time frame. Most commonly, when I'm working with people, I work with 10, 15, or 20-year term. 5-year term, not too much anymore. And 30-year term, you're getting into premiums that you may want to start looking at a more permanent form of insurance. But term insurance is very applicable for young families, for income replacement purposes, for that startup business that desperately is going to need life insurance if something happens to their visionary person. For other purposes in business, a company that just simply needs to have buyout coverage and doesn't have the cash flow to pay for more expensive insurance. Those are all reasons where term insurance could be used. The more expensive forms of insurance, whole life and universal life, definitely have a place in a risk-managed portfolio situation. It could be, again, for the estate liquidity need.
Yes.
And that's where I see it mostly, is for the estate liquidity need, but also sometimes when people are wanting to do charitable planning. They don't know how long they're going to live, and there's an organization that they really care about, and they want to leave something to that organization. So you may see a whole life used there, or a universal life. And I know that people do use whole life, universal life, and variable universal life for deferred compensation purposes, to help give compensations back to executives. Again, that's not something I usually get involved in, just simply because I believe it's a death benefit product.
Okay, so let's talk for just a moment. So whole life, the basic idea, well, first of all, there is a cash value involved, but basically that you're buying a policy that's not going to expire, presumably during your lifetime. As I understand it, it's good to age 100 and then it just pays out the face, or that's the way it used to work.
Well, it can work that way. In most instances, what I have seen, of course, I haven't had somebody yet reach age 100.
Right.
But in most instances, what I understand happens is that the amount is held with the insurance company until the death does take place.
Okay. But the idea, though, is, in a sense, we say it's permanent insurance. During your whole lifetime, you're going to be paying this premium. That's not going to vary. Where term, once you get past that term, then you've got to rewrite another policy, and you'll probably have a higher premium
That
because
is
it's later
correct.
in life.
That is correct. And you also have to go through, for instance, if you buy a 10-year term policy and you find out year 9, well, gee, I'm going to need that for another 10 years. Most of the better term insurance policies have an opportunity to convert them to whole life or universal life without going back through a medical exam and satisfying the insurance company's underwriting. However, again, if the expense is too much for the individual, we re-underwrite the case, have a new application taken, new medical exam, review medical records, and hopefully everybody is still insurable and we can get a new term contract.
Right. And now the universal life, the idea, as I understand it, is that there are investments underneath this. So it's like you're having mutual funds underneath.
That's
the
the
life
variable
insurance.
unit. That in variable universal life, the owner of the policy has the opportunity to pick varying funds that they would like to invest the cash value in. And the insurance company provides those funds, the list of the funds that they have. Fixed universal life, which is called universal life or flexible premium life, is a current money product, and the insurance company does all the investment work on that.
Okay. Have you ever had a death benefit denied?
No, I have not had a death benefit denied. Came close to it one time, but no, I have not. And in my career, after we were talking about this interview, I went back to calculate about $25 million worth of death benefit has been given to families and businesses.
Okay. So how could a death benefit be denied?
A death benefit could be denied in the first 2 policy years, primarily.
Okay.
And that is, if the insured dies in the first 2 policy years, the insurance company basically goes back and re-underwrites the policy.
Ew.
And what they're looking for in that procedure is, were all the facts stated, and were they stated correctly? And I have had a couple people die in the contestability time frame where the policy was re-underwritten, but in neither of those cases was there any problem getting the death benefit. What they're looking for is fraud. Did you not disclose something? Or some, also the suicide provision with most companies is 2 years.
Okay.
There's some few companies where it's 1 year.
Okay. Well, Peggy, we're about out of time. Do you have maybe a final thought that you want to throw out for people to think about related to life insurance?
My final thought would be, if you have a family, if you have something you care about, if you have a business, look over your life insurance and be sure you're adequately insured. The best gift that you can leave a family, a business, or community is the gift of well-being.
Okay. Thanks for being my guest.
You're welcome. Thank you for having me.
Okay. Hope we'll have chances to talk about some other subjects. Folks, take a look. Think about, is your family adequately protected? And we'll see you next time on Financial Insider Weekly.